Hey everybody, doing I guess a quick video if you want to call it that. Just with some thoughts on the market. Kind of basically, it's not quite the end of the month, but as it stands right now, it's pretty obvious how I'm going to approach this market. Um, just as I'm starting to kind of see the ingredients for a Fed-induced recession. If you don't know what that is, that's basically where the Fed is late to raise rates. This is what everybody's been saying. So now you have inflation that's kind of high. But now that inflation's starting to turn, the Fed is not looking around them seeing the slowing. So it's pretty obvious that it's probably going to be um, the Fed's going to so by September 15th or so, I believe the market will probably they'll do another 75. Powell just came out pretty hawkish, and the market is reacting to that, breaking through some key support levels. 41.20 was a key support level, but as you can kind of see, market's kind of selling off right now. It's stopping at these different support levels. It's trying to hold around there as the bulls like have some kind of hope. There's not much hope. Like there's not much hope. It's pretty rough right now. The bond market is kind of telling you what's going on here. As you can see, um, 10-year yields are moving barely. The 3 month is up dramatically. So right now, it's just a matter of time because the market's just going to process what they saw today and maybe oh maybe he didn't mean what he really said. And but if you listen to any of the other Fed speakers, they're very clearly okay with like a mini recession, I guess if you want to call that, because they think that they can just snap their fingers and make it stop. But recessions don't work like that. You can't just start a recession, snap your fingers, and then make it stop. It's stupid. It's childish. I hate every Fed speaker that talks about raising unemployment just kind of casually, just, oh, we'll just raise unemployment. And then workers won't have to talk about wage increases anymore because they'll be too worried. Look, they're going to have to cause something pretty bad, and it looks like they're kind of heading that way. So the 2 years kind of telling you the story of what's going on right now. 10 years kind of climbing too, but this is going to further basically just slaughter the housing market. Um, you should pretty soon here start seeing pretty big layoffs in the housing market. The refinance part of the market's already been just kind of killed, but this is just going to further just kill off what's left of the housing market in a pretty bad way. The market's just trying to cope with this information right now, but yeah, so you can just kind of see what's going on. So what did I do? Like, what's kind of my plan right now? So I posted on Twitter a few days ago that I pulled back on QYLD. My portfolio is fairly exposed to tech right now. As you can see, this is technology related. BST, BSTZ, QYLD, and NUSI is also all. These are all tech related type things. So up here alone, I put 11,000, and then you have another 2,000 give or take there. So rates go up, tech's going to get hammered. It is possible that we try to retest the June lows. It is possible. That would be 36.66. But it's pretty obvious that the Fed's going to raise 75, and then they might raise 50 or 50, but it depends on the September 15th press conference. But between now and September, it's going to be pretty ugly in the markets. So what I did is I got rid of some QYLD to reduce my exposure to tech by a good bit. Um, and I sold out of it, I think at like 18.21 or something like that. So I avoided a large amount of losses there. And also, my entire portfolio, out of everything that I have here, QILD is the only thing that I don't have dividend reinvesting turned on for because I don't want to add to this position. This position's good where it's at. So when that pays out, I'll probably just put it in a cash balance. I also added CSX since the last time I did a video, just basically train company, just trains. So I like them. They're all over the country. See them all the time when I'm doing DoorDash. So just kind of adding to that position. Also, right now, basically, there's no the reason why I'm doing the video today is because there's what I'm basically doing right now is between now and probably the end of October, if I had to guess, whenever we get our next earnings season. So, we just got done with earnings through here. So, probably around here, we will have far more clarification on where earnings are going. And you can kind of see which stocks also pay out in October. Dividend stocks. So here's what kind of pays out: Coke, Regions, that type of thing. MO, they just increased their dividend. I might actually add to them if once they drop. Sin stocks tend to do pretty good in a recession, but you can kind of see just a number of things that pay out in October. And then we got November, obviously, with just these different stocks. So we need earnings guidance clarification now. Um, so what we need to figure out is how much, because housing's done for. That's pretty much done for. So what we need right now is some type of clarification from companies on how these rates are starting to feed through, because rates feed through very, very slowly. And that's why I believe the Fed is making a mistake right now, and a lot of the market believes they're making a mistake, is these rates take a very long time to feed through into the economy. It doesn't just happen right away. It happens in the market right away because they price it in 6 months ahead, but it takes a long time for these rates to feed through. So by October, consumers are going to start feeling the 75 basis points that they did in June. And then by December, maybe they might start feeling the one in July. But what about the one that's coming in September? So it just kind of adds up. So what I did is I was kind of like just been looking at all the different charts and whatnot. So the bears and the bulls have been fighting with each other. So this is kind of what a typical bear market rally looks like. This is what this bear market has looked like so far. And the next leg down, if it follows a regular bear market, I believe, where are we at here? So it's kind of setting up that it wants to go below the June lows. So that's going to be the big thing. Is does what's going on in the market right now with all of this and what you see here and all of this, because these rates are significantly higher than they were in June. So as you can see here, so right there, you see that June, so that's that 2 year. So we're heading back towards that. And the market was at 36.66 when the 2 year was at this right here. So that should give you a general idea of what type of drop we could end up seeing from the current levels. As you can see right now, we're trying to hold 41.20 in that area. That's what the bulls and all the technical guys are trying to hold. But they're all digesting what Powell said. But I mean, you can kind of see we're kind of getting back towards that area, especially in September when they do raise, and then they say they're going to raise again, and then they say they're going to raise again, and then they say they're going to hold the rates higher. I think Powell needed to talk tough today because the market got very far ahead of itself very, very quickly. So that's kind of where we're at right now. But right now, I'm waiting to see what earnings come in at before I really start dedicating a lot of money. So probably by the next time I do a video, this number right here, because I did put some money to work yesterday in some more higher conviction type things, into like just different things. I had it right here to KBH. This one's just been beaten and slaughtered, so I didn't add too much, but I added a little bit there. Just different places I added to. Where are we at here? I forgot which one I added to yesterday. I added some to Pfizer. It's like a healthcare type thing, especially going into the fall. You're going to get more COVID news. And then, just add it into little different spots where I think we're going to be okay, just in places that I have. But for majority of it, it's staying in the cash balance. So by the time I make another video, this will probably end up saying about 4,000, as I just have different money that comes in from the DoorDash stuff over here that I'm just going to put into the cash balance. Right now, what I'm waiting for is to see if we break out below the June lows. If we break out below the June lows, I mean hefty that's a hefty fall from where we were. We were at 4,300. That's where it ran back up to, and we break out to the June lows, which are down here. So we might break a lower. So we have to kind of see what breaks in the market. The big thing is going to be earnings. That's what we're waiting on. The market could end up just trading sideways before then, but so what I did is basically I just am building up a cash pile right now. I have dividend reinvesting turned on for everything on my portfolio except for QYLD, and I'm just going to build up my cash pile right now because we're kind of to that point where you're going to start. I think you're going to start seeing it in the employment numbers at some point here pretty soon. Even though the employment numbers have been amazing, it takes a lot for all of this to feed into it, into our numbers. And you can kind of see the dollars heading back up. Other currencies are getting weaker. Plus, we're heading into like the winter time, where nat gas is just tremendously higher. Demand on nat gas is going to be much higher. Um, OPEC's even talking about having to cut production because they don't like where the price of oil is heading. Well, you caused a recession. It's kind of your fault. Actually, you caused a worldwide recession, so it's kind of your fault. Um, so I think that's kind of where we're at right now. So I'm building up my cash pile right now to be kind of ready when this kind of turns. Um, it looks like it wants to get kind of much more ugly. Right now, once the bulls kind of give up, which may happen, it depends on what they read into that speech. But I mean, it's not just Powell saying this; it's every other Fed speaker too. So I think we're going to break below this 4120. If we break below this 4120, I think the next support level is somewhere around 4020. It's pretty low. Like if this breaks hard lower, we go lower very quick. And then once you break that, then you're back into the 3000s. And then once you break that, you're back. It's not going to take very much to reprice this market. And I think you can kind of see where it's like this is all technical. This is not humans doing this right now. This is all machines. So that's why I say right now I think it's going to break lower. Not sure what the market's waiting on, but I'm pretty sure that maybe they're waiting on earnings or something. I don't know. It could be Monday, but we might trade sideways until then. But as you keep getting rate hikes and they're not going away and they're going higher and higher, I think the market's going to kind of keep pricing in higher, and you can see. So that's kind of where we're at now. So basically, right now, building up the cash pile, have dividend reinvesting turned on. Um, I think this is about as far as I can reduce this, unless I want to eat the losses here and do this like a tax write-off, which I really don't want to. But so that's kind of where we're at right now. If I see something that's very like something that like a really nice one, so for example, I've been waiting for this one right here, Church and Dwight. I've been waiting for this to drop back down to that 82 range. So you can kind of see it on the chart right here. Right here in June, you see how it dumped right here? So I'm waiting for it to get into this 81, 82 range. I want to see if it gets there again. And I think a lot of stocks will probably end up heading to where they were in June. But the good news is if we somehow manage to not go lower than June, that's actually bullish because that means you didn't break below the lower lows. And that's a really good thing. So you didn't make a new low, which is really good if you look at a chart because you basically draw the line straight up from the bottom now, on how the technical guys do this. But it's really going to come down to earnings in October, going into year end. Are we going to start to see that big time slowdown going into like basically an actual recession where you have jobs starting to get like just chopped in half? So that's kind of where we're at right now. I'm going to title this basically red flags in the market, or I don't know, I'll title it something, but recession red flags, because they're definitely there. They're definitely there. Housing is sending a dramatically just like screaming alert red flag right now, and the Fed is very hard headed, trying to act tough, and they're going to drop us clean into a recession. It looks like. So that's where we're at. Sorry, I wish it could be more positive. It would be nice to get back to positive videos, but yeah. Gotta call them how I see them. So that's where we're at. Thank you. Leave any comments, of course, and have a nice day. Thank you.